Hi, everyone. We've discussed the concepts of the basic EPS and also the diluted EPS. And we talked about it, of course, why, for example, we would need to calculate the diluted EPS, right? As an extension to the concept, we would now want to look at that how do these options or the warrants, which are again an example of potential shares, how do they impact the measurement of diluted EPS, right? You would normally see instances like we have employee stock option plans, and of course the accounting is covered under ind AS 102, right, which is share based payments, right? So you would see that when organizations are issuing such options, right, wherein, for example, in case of an ESOP, an employee can buy a share or has an option to subscribe to the share in a company at a less than the market price, as an example. Or there could be some warrants issued to somebody, and these warrants have again a characteristic that these may be converted into shares later. So these are again the potential shares. Okay, so how does the dilution look at it is something that we want to talk about in this particular context, right? We say that again from the perspective of the options in warrants. We certainly assume that these will be exercised as well. Okay, these may or may not be exercised eventually, but till the time that decision is done, we would factor those options or warrants as if they will be exercised, right? Just like the way we did it for the convertible debentures. Okay, and whatever we receive, in case we are, let's say, in case of an ESOP, right, in case we are charging some price for the shares, right, or for the options, so that these may be exercised, something like an exercise price in itself, right? So that exercise price shall be compared with the average market price. Okay, so at any point in time, when you compare or to calculate this calculate this the value of the option, for the purposes of accounting, you would compare that with the average market price during that period, right? Period of calculation of the diluted EPS. Okay, and any difference between whatever are the number of shares that you're going to issue, right, at that exercise price versus the number of shares that would have been issued at the market price. So the difference between the two would represent the shares issued for free. Okay, so effectively, if I say that you are going to give 100 shares under the option and the exercise price is 10, that makes it in total 1,000 as the total amount received if those options were exercised. But if I say the market price, well, let's say 20, then we are saying that effectively on this 1,000 at a market price of 20, 50 shares would have been issued at full. Okay, so whatever money you collect, you would have issued, you would have only issued 50 shares to collect that. But in reality, if you're issuing 100 shares, the balance 50 shares are assumed to have been, of course, issued for a nil consideration or a zero value. Okay, and that is where the impact of dilution starts coming in, right? So we say that simply, in case the issue of the shares are or the issue of the share is made at less than the average market price, then automatically the dilution impact is going to be considered in this context there, right? And that is where you start looking at the amount of dilution is the average market price less the issue or the exercise price in case of course, any options or warrants under the consideration. Okay, let's have a look at this example. It says that Ganga Limited has 50 lakh ordinary shares in issuance. Also, it has 2.5 lakh warrants in issuance. These warrants are convertible into shares at 100 rupees per share, and the average market price is also 100. Now, essentially, when the exercise price is in this case equal to the fair value or the market price, we say there is no dilution impact arising. Okay, that's something that you want to consider. So they would simply be ignored for the measurement of diluted earnings per share, right? Let's have a look at the second scenario. It says Yamuna has 50 lakh ordinary shares in issuance. It also has 2.5 lakh warrants, and these warrants are convertible into shares at 60 rupees. Now, this is the exercise price, which is 60. The average market price is 70 rupees, which means that this 10 rupees differential. So this is the fair value, which is 70. So the delta of rupee 10, right? The difference between the market price, average market price, and of course the exercise price is resulting into the dilution, right? And that's something that we need to kind of consider. How do we calculate that number of shares is something that we're going to see, of course, in some time. So we're saying that to the extent of this difference of 10 rupee, there is a dilution because these shares are issued, but nothing is received in return. Okay, let's have a look at this again. It says Godavari Limited has issued to selected employees the share options that can be exercised after 4 years of services. Now, these are again outstanding, for example, let's say for the purposes of diluted EPS calculation. So again, a normal ESOP environment, when you look at such kind of exercises, safely assuming that these are available for free. So you start looking at, of course, considering them for the dilution purposes also. Okay, now let's have a look at this example. It says that Kaveri Limited had issued share capital of 20 lakh ordinary shares of rupees 50 each. It also granted options that provide the holders to right to subscribe for ordinary shares between 2021 and 2022-23 at 140 rupees per share. The option outstanding during at the end of year 31st of March 17 and 18 were 3,15,000 in each of these years. There were no grants, exercise, or lapses of options during both the years. It also mentions the profit after tax attributable to the ordinary shareholders for the 2 years are 2,50,000 rupees and 3 lakh rupees respectively, purely with respect to the continuing operations. The average market price is also provided at 240 and 320 rupees respectively for 31st of March 2017 year ended and also for 2018. The question is calculate the basic EPS and diluted EPS for each of these years. Okay. Now, importantly, since we're talking about 2 different years, these numbers are both important. Okay, these values are both important because we want to compare these to the exercise price, which is 140 in each of these scenarios. Okay, that is what we're given, the right to subscribe for the ordinary shares at 140 rupees per share. Now, the difference that you see is 100 and 180, right? For the year ended 31st of March 17, the delta or the difference is 100 rupees. And for the year ended 31st of March 18, this difference is 180 rupees. Okay, so when you look at that number, on that basis, you would be required to calculate the basic or the diluted EPS. Basic EPS is fairly straightforward if I were to pick that in this particular question. So let's take the first step, of course, wherein we say that the basic EPS for the year ended 31st of March 17 and year ended 31st of March 18, right? So we calculate that. We have profit for the year, that is 2,50,000 for 2017 and 3 lakh for 2018. Okay, we're also given that the number of shares outstanding is 20 lakh, right? very comfortably, the basic EPS can be calculated simply as, if this is 1 and this is 2, we are saying 1 divided by 2, and we get the answer there. So this is 2,50,000 divided by 20 lakh, that gives us 0.125. So the next year, this becomes 0.150, right? That's the easy part of the discussion. The second part that we want to address is that for the year ended 31st of March 17, where the average price is 240 and the delta is 100, because you are issuing those, or you are offering to have the shares available to the subscribers at 140 rupees. So there's 100 rupees difference. Okay. So likewise, in the second year, the difference goes at 180, right? And the number of options which are outstanding during each of these years is 315,000. Now, essentially what we're saying is that the number of options during this year are 3,15,000 and 3,15,000 here as well. Okay. Now we are saying the equivalent number of shares, the equivalent number of shares during this period. So if I look at it again, we are talking about the exercise price of 140 versus the average market price of 240, right? So the way we calculate this is that instead of taking the equivalent number of shares, we might rather, want to take, for example, what is that free element? Okay. So instead of using, or we can rather use it in the same, let's say, column. So we are saying the shares issued for nil consideration, right? So as you observe that the difference is 100 rupees for the year ended 31st of March 17, and it is 180 rupees for year ended 31st of March 2018, right? So we are saying that this will be 315,000 into 100 divided by 240, and this will be 3,15,000 into 180 by 320. So we're simply taking those gaps. These are the free element of the delta as we are using. And when we do this calculation, this becomes 3,15,000 into 100 divided by 240. That gives me a number of 131,250. Likewise, we have 180 divided by 320. This gives us 177,188 approximately. Okay, it's 187.5. So we take the rounded off figure, which is 188 in this. And once we have got these numbers, we have our existing number of shares, which are 20 lakh in each of the 2 years. Okay. And with that number, we can certainly calculate the diluted EPS, right? We can calculate the diluted EPS for the year ended 31st of March 2017 and 18 respectively, right? So we are given this amount of 131,250, right? And this is this is the profit is of course 2,50,000 and 3 lakh respectively, right? Just to clarify that, 2,50,000 and 3 lakh, and the number of shares is 21,31,250, and in this case it is 21,77,188, right? Of course, the diluted EPS can be calculated as 2,50,000 divided by 21,31,250. That gives us 0.117, and then we have 3 lakh divided by 2177,188. That gives us 0.138, right? That's a way you are able to, of course, do the calculations and get the answer of the, or get the answer around these two calculations of basic EPS as well as the diluted EPS. Okay, let's have a look at the formal solution. We did this calculation already. We had those basic EPS and let's go back there, 1.125 and 0.150. So we did this calculation. We got that 0.125 and 0.150 for the 2 years, 17 and 18 respectively. And then for the dilution part, we simply picked up the relevant number, which is this number and this number, right, for the respective years. And the adjusted numbers of shares are also measured at 2131,250 for the March 2017 year end and 2177,187 for the year ended March 2018, right? Finally, of course, the dilution is calculated. It is 0.138 and 0.117 for 2018 and 2017 respectively, right? The nil consideration shares are simply added, let's say, to the total number of shares to arrive at the the relevant number of course, the number of shares for the purposes of calculating the diluted EPS. Okay. Employee stock options, we have discussed that as a context already. It's pretty much the similar calculation. We are considering them as a part of options for the purposes of calculating the diluted EPS. It is irrespective of the fact whether these are vesting or these are contingent, right? There is a dependency on the market conditions, service conditions, etc. That's where you start looking at the relevance of those, and they are treated as outstanding on or from the date of grant itself, right? Specifically, performance-based options are treated as contingently issued shares because that is where you start looking at the the contingency of the conditions, right? There could be some conditions specified over and above the service condition wherein they are supposed to serve, the employees are expected to serve, for example, let's say a period or a vesting period in place. Okay, so for example, if I say that there is a company, Himalayas Limited. The profit attributable to the shareholder is given as 24 lakh rupees. The weighted average number of shares outstanding are 10 lakh. Average market price is 10 rupee. The weighted average number of options are 2 lakh. And the exercise price is 7.5 rupees, right? The question is calculate both the basic EPS and diluted EPS. The basic EPS would be simply you took at the profit attributable divided by the weighted average number of shares outstanding. So we're saying the basic EPS is 24 lakhs divided by 10 lakh. That gives 2.40 or rupees 2.40, right? The moment we look at the diluted EPS, right? The easy path is my average price is 10 rupee and my exercise price is 7.5 rupee. Okay. So essentially the delta is 2.5 rupees. Now this comes at 1/4, which means that there are 50,000 worth of shares. In terms of number, there are 50,000 shares which add to the dilution. So these are the shares which are assumed to have been issued for nil consideration, right? These are the number of shares which are assumed to have been issued for nil consideration. Our existing number of shares are 10 lakh. So we would say that on the profit of 24 lakh, there are 10 lakh 50,000 shares which are outstanding to arrive at the diluted EPS, and that becomes 2.286, and that is where you're able to measure that diluted EPS in this kind of a scenario. All right, let's have a look at the formal solution. It says that basic EPS, simply 24 lakhs divided by 10 lakh, that gives you 2.4. And then we are saying the equivalent number of shares which are issued practically for free, right? Which are issued for a nil consideration is something which is there. So essentially, your dilution would be reported on this basis, and you calculate it like at 2.29 or 2.287